Folks, Dick Moran here with Consumers First Mortgage, bringing you another Consumer's Moment. Thanks for tuning in. I went to a seminar the other day and there was some real good information about where our industry has progressed over the last few years with regard to underwriting and debt to income and so forth. I thought I'd share some of that information with you. Bear with me if you will. It's been a bumpy ride, needless to say. Back in 2007, we could do loans with FICO scores that had a 575 level and 97% loan to value. Go figure, if you would. In 2007. 2008, we changed that. It went up to 620 for a FICO score. We could only do owner-occupied properties. We had to verify income, and toward the end of the year, we lowered the loan to value to 95% with a 45% debt to income ratio, and we started to restrict second homes. That's in 2008. That was probably the worst year that I recall in the industry. In 2009, no more cash out transactions with mortgage insurance, no second homes. Debt to income was reduced to 41%, and in the tier 1 states, 95%. We had a 680 credit score minimum. But things started to look up. In 2010, the FICO score dropped back to 660. We could do 45% debt to income ratios and 97% purchases with a 700 FICO score. The 45 DTI was with a 740 FICO score. In 2011, 660 FICOs. We allowed gifts from relatives, and loans went back up to the 750,000 level in the mortgage insurance industry, something that hadn't been seen for quite some time. You know, there are a lot of predictors to foreclosure. That's the information that the MI companies probably have the best resource for. And what they tell us that loan to value is still very predictive. I don't know if you can see that, but as you can see, this increasing scale, that's 95% loan to value. This is 85% loan to value. Look how much more likely a foreclosure is at the higher loan to values. Debt to income is also very important. 45% or greater or less than 36%. As you can see, the trend is ridiculous as the debt to income increases. But the single most significant predictor to foreclosure is still the FICO score. 620 and lower, look how high. 720 and greater, look how low. So what I'm trying to share with you is that regardless of how much money they have in the bank, if they don't handle their finances well and they don't handle their personal life well, they're not a good credit risk. 53.1% of our population has a credit score of 700 or better. 53%. FHA has been the scapegoat, if you will, for the mortgage industry of late. I told you before that they have their problems. What I want to try to do is share with you why I believe that's so. Capital reserves in the first quarter of 2009 were at $20 billion for the FHA program. In 2010, they dropped to $11 billion. In 2011, $8 billion. And after the second quarter, they had only $2.5 billion on reserve in the FHA program. Any much more and they'll be out of business. That's why the FHA rates have risen so dramatically and are forecast to go even higher very soon to prop up a very ailing system and a very ailing loan program. So I look to the conventional markets to do what the FHA program had been relied upon to do for some time, and here's what we can do. Conventional loans with private mortgage insurance still can do 3% down payments. You got to have a 700 score, but if you don't, 5% down payments to a 660 FICO. Debt to incomes with a 740 score at 45%. All others 41%. 5% down on condos. Condos almost fell off the radar screen for a while. And seller contributions, a very important factor. 6% if you've got 10% down or more. 3% for all others. That's what the topsy-turvy mortgage industry has done. This is where we stand today. I think it's going to get better. We have been isolated and insulated to a degree here in the northern New England area, but we still have our bumps to go. So if I can help you in any way, give me a call. Thanks for tuning in. I hope you found this of value.